Jim, you look at what the market has been able to look past. Are you surprised at how resilient it is when I tell you that we're still doing 480,000+ new cases of COVID a day?
Well, it certainly remains surprising to us that the market, and for that matter, the economy, continues to be able to find ways to grow despite not just the Omicron variant and its toll, which really has yet to be fully rung, but also ahead of the new variant. We already saw dramatic labor shortages. We saw all kinds of shortages in terms of commodities across the board, not just here, but globally. So the fact that this economy and the market that's correlated to it continued to drive higher surprised us a bit, but we were already prepared to be able to ride some increased volatility this year. And because of what happened last year in terms of the sudden swoon and then the steady rebound, we learned a few lessons there in terms of how to not just stay the course, but better maneuver our portfolios to ensure that we are taking a safe but still profitable route.
Getting a little spoiled, too, Jimmy, aren't we? 3 straight years of double-digit gains for the S&P 500. Now we've got some tough sledding coming on the hill in front of us. Prospect of higher interest rates, more active Fed, who knows what with COVID. What's 22 going to look like?
Yeah, indeed. 21, we have the perfect alignment of massive fiscal monetary stimulus and the vaccines helping normalization. Next year will be the first time in a number of years that the market has to stand on its own. We're not going to get additional largesse from either the fiscal side or the monetary side. In fact, on the monetary side, the tide will be turning, right? The liquidity may be receding at some point. So I do believe it's going to be a more volatile year. And historically, the third year of a bull market tends to be choppier, more difficult to get gains. And, typically it's because inflation starts to run higher, the Fed starts to respond. So as a result, the third year is usually a fairly challenging year.
Jimmy, just to follow up on that, you think market activity will also be bifurcated? There will be differences between, say, the first half of the year and the second half of the year. What should investors be expecting, and how should they put money to work now to account for those differences?
I think in the first half of the year, we're still getting the benefit from the strength in 2021. Some of the supply chain disruptions will lead to some deferred sales getting delivered in the first half. There's some inventory restocking. We will see reacceleration by, on the service side in the second quarter, in the springtime, as we get beyond Omicron. So those are positive drivers. But at some point, we run out of additional inventory to fill, and things will start to decelerate. So my expectation is that by late 2022, growth would decelerate back down to trend line and perhaps even below trend line. So as such, it's kind of a year of two halves. The first half probably more driven by, the cyclical stocks, value stocks. And by second half, you probably want to position for higher quality, more defensive names.